Hello and welcome to Portfolio Matters Weekly Update, week 47. And it's been another dramatic week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got in this busy week?
Yes, sadly, it's been a busy week and not in a good way. But before we get into it, a quick reminder that pub night is coming up on Wednesday, the 1st December at 6:30 p.m. in the Princess Louise and High Holborn in London. And it would be great to see everyone. Okay, so news this week. Well, it was actually quite a lot going on this week. So the US House of Representatives have passed Biden's $1.75 trillion social spending bill, which Kamala Harris seems to think will be anti-inflationary because obviously spending $1.75 billion in an environment where there's already seems to be an excess of demand and rising inflation will somehow reduce demand anyway. The ECB has meanwhile revealed that its informal limit on purchasing the bonds of sovereign nations has risen to 50% of outstanding bonds. Now, previously, we thought it was 33%, but they've breached that. And that is one of the dangers of this process is you get trapped. And we will see later as you go through the checklist that Greek bond yields are rising. So they're going to have to keep on buying them. And are they going to keep on raising this limit? Biden has nominated Jerome Powell for a second term as Fed president, and you'll see that's had quite serious knock-on effects in bond markets, and people are expecting more interest rate rises next year. And in oil markets, Biden has coordinated the release of stocks from the Strategic Petroleum Reserve, and that is meant to be in coordination with the UK, India, and China and others. In Turkey, the Turkish lira totally collapsed. It's down by 15% in a day as President Erdogan continued his policy of lowering interest rates to fight inflation. And finally, today, equity markets are taking a total bath because we have discovered a highly mutated form of the coronavirus in Africa, and the UK put on new travel restrictions with South Africa. So markets are worrying about further lockdowns. Okay, so this is the Turkish lira. I wanted to quickly show you this chart because it shows what can happen if a country loses the confidence of the market. So this is over 10 years, the number of lira to the dollar. It's gone from 1.5 to 12.7 now. So if you held the Turkish lira 10 years ago, 1 lira would be worth about 15 cents if it was worth $1 10 years ago.
The other thing here, Keith, is yesterday they were hit with 10 or 15% price rises in normal goods. And if you put yourself in the position of you go out to the supermarket and the bag of sugar is 15% more expensive today than it was yesterday, it creates panic. And all countries, all highly indebted Western democracies are teetering on the brink of this, in my view. And I think it's a salutary lesson to us as to, what's your plan B? If this happens in the UK or in Europe, what's your plan B?
Oil and gold, mate.
Yeah, exactly.
We're always going to need oil. sadly, gold has not been a great investment this year, but
Wow.
it should hold its value in the face of rising inflation, he says.
We'll talk about that later.
Well, exactly. So this week's economic data, and you'll be glad to hear it was a data light week. But we had lots of PMIs. So in the US, the manufacturing PMI came out strong at 59.1, up from October, ahead of consensus. But the services PMI came in weak, weakening slightly, and that led to the composite coming in below expectations and down on October. And that is actually the only negative piece of economic data we're going to have this week. So in the UK, the manufacturing PMI was strong, up 58.2, up from October, now well ahead of consensus. The services weakened slightly to 58.6, down from a strong reading October, but beating expectations. As a result, the composite rose in November from October and was ahead of expectations. In the EU, consumer confidence came down slightly to minus 6.8. Now, it's a source for amusement that every month we have EU consumer confidence is always negative. We will show you a chart. I don't think it's ever turned positive. The EU manufacturing PMIs were strong, 58.6, up from October, well ahead of consensus expectations. Expectations were for it to weaken. So despite all the supply chain disruptions, etc., the European economy looks okay. The services PMIs were good, well up on October and beating expectations by a margin. As a result, the composite was also strong and well ahead both October and expectations. We had some quarterly numbers. Now, I think these quarterly numbers are quarterly data annualized. So corporate profits in Q3 in the US rose 4.2%, down from Q2, but still very strong, but they missed expectations. GDP growth was 2.1%, down from Q2, but ahead of expectations. Inflation continued strong, 5.3% in the US, which matched expectations. So I think what this tells us is the markets have raised their expectations, and although inflation's coming in hot, is no longer surprising the market. And the same is true for core PCE inflation. Remember, PCE inflation stands for
personal consumption expenditure.
Yeah, stands for personal consumption expenditure. Thank you, Richard. And is the Fed's preferred inflation measure. Okay, so let's take you through some charts. Richard?
Thank you, Keith. EU consumer confidence, as Keith says, it's rarely, well, never since this chart started, above zero. EU manufacturing has, it's not really going anywhere at the moment. It's above 50.
Stop falling.
Yes. EU services, likewise, above 50. And the composite PMI is above 50, and really not terribly interesting. It's shown that the EU is expanding gently.
Mm-hmm.
UK services PMI is high, and it's remained high for quite a while now. US manufacturing PMI is actually looking quite healthy. I know it's fallen back, but it's picking up a little bit now.
Sorry, Richard, you said US. Do you want to do that again with UK?
UK manufacturing PMI is it has fallen, but it's just picking up a little bit now, and I think it looks reasonably healthy. And UK composite PMI is looking reasonably healthy as well. US manufacturing PMI is looking strong, and US services PMI is actually looking a little bit less strong. Looks like it might be in a little bit of a downtrend now, and the composite US is difficult to tell what it's doing here, whether it's stabilizing in the high 50s or whether it's going to move down. US initial jobless claims, just under 200,000. And do you have a comment on that, Keith?
Well, the US initial jobless claims came in at 199,000, and that is the lowest level since 1969. Now, there's a contradiction here between the US services PMIs, which came in slightly weak, and actually what looks like a red hot jobs market.
Yeah. And the US continuing jobless claims at around about 2 million.
Okay, on to Inflation Watch, and we had no new data this week because we've got the full table for October, and the month has been one of generally rising expectation, so rising inflation and inflation coming in above expectations. Now, if we look at the US and the components, you'll see that it's really quite broad-based. So beef has gone up 24%, motels and hotels up 26%, gasoline 51%, eggs 12%, furniture and bedding 11%. Essentially, inflation seems to be very broad-based, and as a result, consumers' inflation expectations are rising, and you're getting rising wage growth. So from my perspective, I see all the ingredients for a wage price spiral developing.
Yes, I agree.
Now, in the UK, this is data on how COVID has disrupted the UK labour market. And you'll see that we're still getting quite a lot of people who have left the labour market because they're long-term sick or they're temporarily sick. So COVID is still causing disruption, but you're also getting an increase in the number of people who have retired. Now, as we've talked about on previous weeklies, one of the side effects of all this monetary largesse and ludicrously low interest rates, remember the US real rate is now currently about -5. So is that asset prices have gone through the roof, and lots of older workers who have a pension pot and savings now feel they have the necessary wealth to retire. So monetary policy is having an impact on the labour market and reducing the pool of available workers, which should cause wage inflation. And you can see that effect in the US here. So the blue line is the actual number of retirees. The pink line is the predicted number. And that gap is a 1% excess. So 1% of the population appears to have disappeared from the labour market. Other news, lumber futures have had a hell of a year, having essentially quadrupled and then come right back down again. And then in the course of the last few weeks, they have shot up by about 60%. And moving back to Europe, winter is coming. We are short natural gas and electricity prices are going through the roof. Bear in mind that long-term electricity prices in Europe were around 40 euros per megawatt hour. So in France, a couple of days ago, you're talking about almost 300.
Yeah.
And this was a couple of days ago. And the French day-ahead electricity price had breached 300 euros. Germany was not far behind. And the EU carbon price continues to rise.
It's very difficult to know what the long-term consequence of this is going to be, isn't it, Keith? Because it plays into so many different features of the economy. But you can be pretty certain it's not going to be good.
No. Well, I'm amazed, Richard, by the EU manufacturing and service PMIs, which were strong despite these enormous increases in electricity prices.
Yeah. I mean, I guess if you're a large commercial user, you've probably got a hedge on for maybe you hedge it a year in advance. I very much doubt you're going to hedge it more than a year, and it's quite likely you may only hedge it for 3 months. So it may be that the impact hasn't yet, the full force of the impact hasn't yet been felt in large industrial customers. If you're an electricity, if you're a steel manufacturer, for example, and an electric arc furnace, you're bound to hedge your electricity. So we may see a sudden spike coming through.
Yeah, agreed. And as a result, in Germany, the inflation expectations are rising, although they are still below 2%.
Yeah.
And the Germans are losing confidence in the ECB.
Well, is it any surprise? I mean, Christine Lagarde, she I think basically she's a politician, isn't she? She's not a financier. She doesn't, and her only course of action seems to be able to say we're going to keep interest rates low. We're going to carry on with QE, and as Keith just said a little bit earlier, we're going to increase our sovereign bond purchase maximum sort of limit from 33% to 50%, and all of those things are highly inflationary.
Yeah,
and if anything breaks the financial union, the European financial union, it will be Germany saying we've had enough of this.
Yeah, no, I agree.
The precipitant might be Spain or Italy or Greece defaulting, but it'll be Germany walking away.
Yeah.
Boy, if it does, what a mess there'll be.
Well, we'll show you that later on that Greek and Italian bond yields had a bad week when everyone else's bonds have the prices have risen on the back of a flight to safety.
Yeah.
And as a result of all this inflation, then people have been searching on Google for inflation in both the world and in the US. Black line is the US, blue is the world. But the bond market remains mystifyingly quiescent.
So
Richard.
I think this is an interesting chart. So China's working age population from 1985 to 2012 or so grew year on year. And since then, it has started to drop and is projected to continue to drop. So the correlation that's claimed is that the working age population growth was highly deflationary for the world. And of course, that did coincide with a highly deflationary period of globalization. And therefore, the opposite is going to be true. And we're going to have moved into an inflationary world because there's fewer workers to produce cheap goods for the rest of the world, which is true. Now, the interesting thing here is that if you look at US demographics, inflation predictioners, or predictioneers, have precisely the opposite interpretation, which is as the working age population becomes smaller and people retire, it's going to be deflationary, not inflationary. So I'm not saying one is right or one is wrong, but I am saying that there are clearly arguments in both ways, and I don't think there's any certainty that we have about what the effect of demographics is going to be on inflation.
Well, I read the Great Demographic Reversal by Pradhan and Goodhart, he says, looking at it on his bookshelf earlier in the year. And they make various points, one of which is about demographics in China reducing the number of available workers, but also we are now seen to be rowing back on globalization.
Yeah.
And we featured a chart a few weeks ago which showed the components of inflation in the US. And what it showed was that the price of services had actually risen very strongly over the last 15 years. And things like hospital prices and education had absolutely gone through the roof. But they'd been offset by enormous declines in the price of manufactured goods. And frankly, if the price of manufactured goods stops falling, then you'll see a rise in inflation, and I'm expecting a rise in inflation.
I think that's inevitable, Keith, isn't it? It's inevitable because the China demographic situation, and China is, I think, moving away from wishing to be the manufacturing hub of the world. I think politically it doesn't really want to be there anymore. It wants to move into higher value, high productivity economy, and we don't want to be totally dependent upon Chinese imports for all of our services, all of our supplies, because it puts us in a very, very vulnerable position geopolitically.
Yep. The one thing I'd say is that as the China's wages rise, and that will be a consequence of declining demographics, then manufacturers will seek lower cost venues such as India to manufacture textiles, etc. And some of that shift has already occurred. But that implies a rising Indian middle class and rising energy consumption, etc., etc.
Okay. So this chart, the next two charts are from Lynn Alden, and she has made there are four really interesting charts. So this one is the rolling 5-year cumulative growth of CPI in orange versus the broad money supply in blue. And you can see there's a rough correlation between the two until now. And now we have the broad money supply shooting up year on year, 50%, and CPI relatively muted. So look what would happen to CPI if it followed that blue line up. And then the right hand chart is showing the private sector loans, government deficits, and broad money year on year growth with as a percentage of GDP. And you can see that we have huge growth in government deficits and therefore huge broad money growth. What she's saying here is that the total amount of indebtedness isn't, the increased government indebtedness isn't being counterbalanced by reduced private sector indebtedness.
Yeah.
And this is a very interesting chart. The left-hand chart, I think, particularly interesting. Keith asked the question, why isn't the bond market reflecting inflationary expectations? Well, it doesn't. This chart is basically saying the bond market does not predict inflation at all well. So the blue line is the 10-year, this is US 10-year Treasury rate. And the orange line is the forward inflation-adjusted Treasury return. And what it shows is that at periods of high inflation, the forward-adjusted return to maturity on the Treasuries is negative. In other words, at the point at which the bond was issued, the yield was wrong. It didn't predict inflation. And it's always been my position that actually bonds don't predict inflation, because it suggests there's a degree of insight that I don't think the markets have into what the economy is doing personally. And then the right-hand graph shows that the 3-month Treasury rate is totally decoupled from US Consumer Price Index, which is the blue line, and clearly is being manipulated flat. There's no doubt about it. That is yield curve control. Yeah.
Well, the short end of the curve is very much anchored to interest rates.
Yeah.
But if you buy, US 3-year T-bills, you're locking in a yield of minus 6.1% real.
Yeah.
Okay, moving on to supply chains. So in the US, the supply chain difficulties appear to be easing slightly. And if we look at a breakdown of the components, you'll see that easing is caused by manufacturing backlogs easing slightly and prices not being as terrible as before, and raw commodity prices having come off the high. Now, we've seen, for example, that iron and steel prices have come down a long way. So that's good news. But the general picture is still of quite tight supply chains. We look in Europe, supply chain problems appear to still be deteriorating. And if we look at the components, you see that factories can't get the supplies to run them at full capacity. So you look at construction constraints, there aren't any. And capacity utilization is not a problem at all because you just can't get your raw materials. Yeah. UK looks awful. UK supply chain shortages continue to worsen apace. And essentially, everything is bad. Everything is as bad as it's possible to be, essentially, including job vacancies. Now, thank you to one of our Discord viewers, Richard Wilk, for sending this through. This is from the latest quarterly reports of a global mid-size leasing company, Global Ship Lease, which has a fleet of container ships. And this chart shows the rates, the daily rates in the charter market, and you can see that they are shooting up. So the black line here at 100 is the average leasing rate through Q1 2019 to Q3 2021. And you'll see that over the last 3 quarters, it has more than trebled. It's up 3.8-fold and is still rising. So you're going to see the prices of freight and the cost of the supply chain rising going forward. Okay, now we want to do a segment on central banks because we previously discussed how central banks are trapped. Richard.
Well, Keith, yes, I feel a little bit like a broken record here. We've got so this chart is showing how confident are you in central banks and high inflation eroding US public confidence in the Fed. And the answer is yes, it is. Most people are less confident in the Fed than they were 5 years ago. So very few people are more confident in the Fed. But of course, the trap is that they have effectively been funding excess government deficits. And in order to fund excess government deficits, they've done 2 things. They've introduced quantitative easing, whereby effectively they're buying government debt, although they claim they're not. And the other thing that they've done is they have controlled interest rates, and interest rates are at an artificially extraordinarily low level. And that has enabled them to continue to purchase government debt, and governments continue debt because it's enabled governments to continue to service debt. And the point is that it's got so bad now that they can't get out of it. They can't raise interest rates. They can't actually stop QE. They'll try to stop QE, but effectively they can't because populations have come to expect that politicians will continue to run highly indebted economies because they expect the level of social services, government support, government largesse. And so the central banks can't get out of it, basically. We have high inflation. That'll lead to civil unrest. The cure for high inflation probably would be to increase interest rates. They can't do that because they'll bankrupt the government, they'll bankrupt the private sector. There is nowhere to go. But fundamentally, at some point, the financial system needs to have some sort of a reset. Now, I'm not saying that's going to happen immediately, straight away, or in the next 10 years, but at some point, there is no exit from this situation other than cutting the circle. And cutting the circle will result in some form of a reset. What do you think, Keith?
Well, I think you're right, Richard. Essentially, they have, if you look at the Bank of England, the Bank of England does not have a dual mandate. It only has a mandate to limit inflation and target it at 2%. Now, UK inflation is, I think, was it 5.4%?
Yeah.
And has continually missed the Bank of England's target, and they're still doing QE. And interest rates are absolutely at rock bottom. And the reason they can't raise interest rates is precisely what you've said. We've got a huge stock of debt. And if you every rise in UK interest rates costs the government money, and it's running a huge budget deficit, and you just can't do it, essentially. If I was the Bank of England, I wouldn't be raising interest rates, actually, because I think they're trapped. I mean, I'd stop QE instantly, but you can't raise interest rates because if you do, there's a huge stock of debt and you'll suck demand out of the economy. So if you want to keep the economy going, then you need to keep interest rates at rock bottom.
I mean, there is one way out of it, isn't there? Actually, the one way out of it is inflation. But significant, protracted, prolonged inflation, like 10% inflation for 5 years, 10 years. I don't know what the number would actually have to be to effectively deflate the debt down from the absurd levels it's currently at to a relatively small percentage of GDP. But the pain behind that is enormous. The political pain. No politician in their right mind would opt for a policy of that nature. And I think the fact that Andrew Bailey's most powerful tool, Governor of the Bank of England, his most powerful tool is to say he might raise interest rates. That's what he's got.
Yes. Yeah. Well, actually, on that note, Richard, if you look at the long-term chart of government debt, it really starts to take off from the early 80s when we instigated a global policy of inflation targeting. And one of the side effects of inflation targeting was to reduce interest rate volatility. So inflation volatility, so people felt more able to predict what their interest rate, what their debt servicing costs would be going forward. And they felt more comfortable taking on more debt. And so we've now got this cycle, and we're continually reducing inflation expectations, interest rate expectations are allowing the buildup of debt. And actually, if you were to allow more volatility in interest rates, people would hopefully take on less debt because they would be more uncertain about how much it was going to cost them.
Yeah, that's right. So the next chart, it's not a chart, this is from today's FT. So Mohammed Al-Arian wrote an opinion piece in it, and but I was completely struck by the strapline. The Fed can avert a rerun of Obama's polls shellacking. Well, what is that other than an abrogation of central bank independence?
Okay, moving on to corporate earnings growth, because there are some really astonishing charts in the FT this week. So this is the S&P for consensus forecast expected earnings growth long term, and this is from Bank of America, and they're saying that implied is the 5 to 10 year expected annual growth of 19% per annum, which is the highest it's ever been, higher than during the dot-com boom. And okay, this is a truly awful regression from the FT, who should know better, because they are using data between 1986 and 2020, and they've got far too many data points. So the data points are not independent, and you can't do this because you can get lots of very weird results if anyone's ever tried to do a regression through overlapping data points. But with that caveat in mind, according to the FT's piss poor regression, if this relationship holds, then you'd expect a market drawdown of about 20%. And if we break down the earnings expectations for the big companies in the US, you'll see that some of these earnings expectations are really very strong. So Amazon, who, bear in mind, last quarter made no money at all on rising supply chain costs and delivery costs, they're expecting earnings per share growth of 50%. Although, frankly, as their earnings have collapsed, that probably means not very much.
Yes.
Anyway.
What's it based on, Keith? That's the question, isn't it?
Well, exactly. Okay, profit margins are related subjects. So US corporate margins are currently very high and well above trend. Now, is that sustainable? We ask ourselves. And it's not just the US, this is the rest of the world where margins are also very strong. And one of our Discord members, MW Jackson, sent us this. And this is the gap between producer input price inflation and CPI. Now, so what it says is input price inflation has been much stronger than CPI. Now, there
are two ways out of this, aren't there, Keith? Basically, we assume the companies won't vote, aren't turkeys voting for Christmas, and don't want to go bust. So they either have to, in fact, they have to. If it continues like this, they have to pass prices on to consumers. They clearly have been absorbing it at the moment, and if we move, particularly as we move into a wage price spiral, if we do, then even if their input prices don't get worse, their wage input will go up.
Yeah.
And must be going up now.
No, I agree with that, Richard. But the trouble with this chart is that it depends very much on how you're measuring input prices. Because famously, the price of corn, the amount of corn that goes into a bag of Kellogg's cornflakes represents only about 3% of the cost of the cornflakes. So you can have the price of corn doubling and it has a relatively small effect on the price of the manufactured goods.
But we have I take your point, Keith, completely, but we have commodities across the board going up in price. So cardboard, we know about transport costs, we know about electricity, fuel prices. I don't know what the other inputs are into cornflakes. I guess water hasn't gone up very much. So I think the issue is not one. I agree. If it was just corn had gone up and everything else was stable, the issue is we have prices going up across the board.
No, I agree with that. And of course, wages are the main cost. Yeah. And we know that in the US, they're rising at 5% odd. So you would expect to see that companies passing their costs on. And we know margins are really strong, which suggests they are able to pass prices on.
And of course, part of the issue, we've discussed it before there, is the increasing monopolistic and oligopolistic behavior of large American corporations. And if the Biden administration is successful in breaking those up, then that would result in deflation and more competition.
Yes. Yeah. The chance of that happening, I would put, very low. He might be able to prevent more consolidation, actually unwinding the consolidation that's already happened. Skeptical. Okay. UK consumer spending. Well, we had some more charts from the FT, and UK consumers are doing perfectly well. Thank you very much. The blue line is change in consumer spending compared to 2019. It looks very good. And UK cinemas, their revenues are actually higher than they were in 2019 by a decent margin. People just want to get out, frankly. I found this absolutely amazing. Sandwich shops compared to January 2020. I mean, in Yorkshire, transaction volumes up 60%. Amazing. People are just getting out, getting into the town centres. And this chart is out of date already as of this morning with the new lockdowns. But prior to the discovery of the new COVID variant, flights were recovering. And onto UK commercial property, because this is not a good chart. This is the percentage of staff working at the office. And it's reached, what's that, 23%? That, that's really bad, and suggests that there may have been permanent changes in the way workers use office space.
Well, just anecdotally, Keith, it's interesting. So I do a 1 day a week for a company in WeWork in Tower Bridge, and I would say it's a third full. They have a lot of. It's a lovely building, beautiful offices, fantastic view, and I would say it's a third full. And the modus operandi of this particular company is that it has about 20 staff, and there are 1 or 2 in a day.
Yeah. So
it works well.
Yeah, but companies don't yet seem to have given up a lot of their office space.
No, I think that's right. And of course, it could be the duration of leases, or they're waiting to see what happens. I know some businesses are very keen to get their staff back in, and I think there's a sound reason for that. WeWork actually got busier between August and October. I would say it got continually busier. I say for the last 4 to 6 weeks, it hasn't got any busier.
Yeah. Well, this is the vacancy rate in London, and it's been pretty stable. About much higher than it was previously, but only about 7.7%. And this is data for central London, where there's a 9.1% vacancy rate for offices. But if you look at the orange line, that's availability, and the green is take up, and take up remains quite low. And going back to changing usages of office space, as a company, you do want all your employees to get together occasionally. Now, how are you going to achieve that? Because you don't want to, rent an office space for them all to come in together, 1 or 2 days a week. I don't know how you're going to manage it.
You have to book a meeting room, don't you? Which is the sort of where WeWork is good, because they have meeting rooms, and you can do that. But you're absolutely right, Keith. I mean, if you want more, if you have an office for 2 or 4 people and you've got 20 employees, every so often you'll need to book a meeting room, but it's a lot cheaper than having a larger unutilized office space.
Okay, so another special topic: oil and gas companies' renewable investments. Now, last week we showed you this chart, which shows the cost of capital for fossil fuel companies. So the black is oil, offshore oil, the pink is LNG, and their cost of capital is really high. For oil companies, above 20%. For LNG companies, was that 12%, compared to renewables that everyone is dead keen to invest in, very low cost of capital.
Around about,
so that's good.
Keith, very roughly 4%, yeah.
But then, thank you to Simon W. for our Discord channel for sending us this. This is really interesting. So Equinor, which is a big Norwegian oil company, have stated that their Dogger Bank wind farm, which they've invested in, will have an IRR of just 3.6%. Now, how does that work?
Yeah.
Your cost of capital is above 20%, and the return on your Dogger Bank wind farm is 3.6%. Essentially, economically, these big oil companies investing in renewables, it just doesn't work. They're just not getting the returns they need.
But I absolutely agree. But even if Equinor were a wind generator, wasn't an oil company, its IRR at 3.6% is around about, from your previous graph, around about its cost of capital. And if its cost of capital calculation is wrong because it's using too low a discount rate, because it's using too low interest rates, because inflation is higher than interest rates are currently adjusted for, then it has a negative IRR. It has a negative. So, I'm all in favour of wind energy, but in order for it to have a positive IRR, the price needs to go up.
Yeah.
I mean, a sensible IRR, price needs to go up.
Okay, moving on to other charts. So, good news. The US economy seems to be doing better, and we're having better economic surprises So the white line is the economic sentiment, which is picked up, and the blue line is the Atlanta Fed GDP now forecast, which has picked up very strongly and is above 8% for this current quarter. Now, Jay Powell has been renominated for a second term, and as a result, expectations for interest rate rises next year have increased, and the market's now pricing in almost 3 rate hikes next year.
Almost 3, is that 2 then, Keith?
Well, it's kind of 2.7 or something, you know. Obviously, these are predictions, Richard.
It has to be an interview, Keith.
Yeah. Well, lockdowns in Europe have really hit the euro. And this is a chart from earlier in the week. I haven't looked at it today, so it won't have improved.
The euro is up against the US dollar.
Is it?
Today, yeah.
Okay.
For reasons that escape me.
This chart, thank you to Discord member MW Jackson for sending this, shows that a record number of companies, so the market capitalization of US firms, which don't make enough money to cover their interest rate expense, is at an all-time high by a massive amount. And I think this is probably just all these tech companies with no earnings. But you know what this means is those companies need to continually issue bonds just to survive.
The other thing it means, Keith, is if there's a change in paradigm and these companies are no longer fundable, then there's 4 trillion of bonds to be written off.
Yep.
But where are they sitting? Question.
Not with me, Richard.
Nor me. They're sitting somewhere, aren't they? And it could be quite unpleasant when it goes.
Yeah.
When it pops.
So this is an odd and interesting chart. So I think it was Simon W. talking on our Discord about how bond yields, junk bond yields in the US are rising now, which is odd because corporate profit margins are incredibly strong. Corporate earnings are very strong. The default rate is really low and interest rates are at rock bottom. So why is there a sell-off in junk bond yields?
Well, Keith, I wonder if it's related to the previous chart.
Yeah, that's true. That's true, actually. Maybe this is the sign that the markets are slowly coming to their senses. And on that note, I did some digging. And one of the things that was being discussed was that during last year, when the bond markets were very strong and corporate bonds were in demand, a lot of the bonds that are issued, and they're talking about up to 85% of new issues, were covenant light. So they placed no restrictions on companies borrowing even more, etc. And I wonder whether bondholders are slowly working out what they've actually got, and what they've got isn't good.
And yeah, that actually, that potentially fits with that graph we showed with the amount of debt issued by companies whose earnings don't cover, whose debt service is greater than their EBIT.
Yeah.
And the lenders thinking, oh dear, have we made a mistake here?
Yeah. And actually last year, this chart shows that a lot of the borrowing that's being done essentially has just allowed private equity to pay themselves dividends. 90 billion this year. Earnings forecasts, or forecast earnings growth, appears to have peaked. The bottom chart, the dashed line, is 1 year ahead earnings growth and is coming down.
Yeah.
Now, final chart, you'll be glad to know. So I thought this was interesting because did you know that Antarctica had its coldest winter since records began this year. And it seems that essentially Antarctica was really cold, whereas the rest of the world was warmer than usual. So this global warming is having odd effects.
Yeah. COVID.
Richard, do you want to do these?
Thank you, Keith. Yeah. So new cases pushing countries to introduce more stringent measures. We've seen a lot of that in the news over the last couple of weeks. So Austria is locked down. A couple of Eastern European countries are very close to lockdown, aren't they, Keith? Various countries. I think Angela Merkel wished to introduce a lockdown and was told she couldn't by the Greens, who have now effectively superseded her and have a powerful position in the coalition government. And then a lot of the Northern European countries have restrictions in place. Macron, I think, is considering whether he should introduce more restrictions. So restrictions for unvaccinated people all over the place, which has caused riots in cities around Europe over the last couple of weeks. And the situation in terms of the growth of infections is not looking good. So the UK case growth is picking up. Patients in hospital per million isn't really, I mean, it's pretty stable, has been for the last 4 or 5 months. And the deaths has been stable for 2 to 3 months. So the UK, I would say, is doing okay. And if you look at these international averages or European averages, the UK is the dotted line. So whilst many other countries are reclimbing their exponential growth rates, the UK isn't, it is flat. But many other European countries are increasing exponentially. And this is, case rates are now falling among mostly boosted age groups, which shows that the booster is hugely important in controlling the number of cases and then by inference the number of seriously ill people. This is an idiosyncratic graph. We don't really know what to make of this, but it's interesting to see it. So the booster campaign doesn't seem to have had much of an effect in Gibraltar, although the death rate is very low. And really, you have to run this pandemic, I think, by the hospitalization and death rate, not the case rate. And in Israel, we've had the case growth has the number of cases has declined dramatically as the booster campaign has had clearly a significant effect on both the case rate and the death rate.
Well, the booster campaign seemed to be contemporaneous with a massive increase in case growth, but the death rate, which is what you care about, has collapsed.
Yeah, and I think it's one of these multifactorial things. So a little bit on this new variant. So it's a variant of the Delta variant that's been detected in South Africa. They've only found about 50 to 100 cases of it. The fear, I say only, I mean, we don't know how many cases they haven't found. It has about 50 mutations in comparison to the original Wuhan virus.
Wow.
So the spike protein particularly is of a very different structure. And so the fear is that the structure of the spike protein is sufficiently different that it will render the immunity granted by the vaccinations that we currently have either irrelevant or much weakened because those vaccinations have been based upon the original spike protein. Now, we don't know if that's true, and only time will tell, but that's the concern. So what makes me feel optimistic is the fact that we have moved so fast to limit international travel to those countries where it's been identified. And the world is now much better to make rapid decisions in terms of controlling it. We don't know whether the current vaccines will, how effective or otherwise they'll be against it. And clearly, we are going to have to move into an era where we have the flu vaccine. It's a COVID vaccine. It'll vaccinate against 5 or 10 variants every year, every 6 months. And we're going to go through a multi-year vaccination program. So the vaccination program isn't over, it's only just started.
Well, the big question is how deadly is it, basically? Because generally viruses become more infectious but less deadly over time. And if it's doing that, that's great. You know,
we don't know, Keith, but I guess
Yeah.
you work on the assumption that it is potentially as lethal as at least the Delta variant, since it's a variant of the Delta variant. And if it's less lethal, that's good news. But I think we probably work on the assumption that it is as lethal.
Right.
But we don't yet know whether how spreadable it is, you know, what its R number is.
Yeah. Well, on a personal note, lots of my acquaintanceship seem to be having COVID at the moment, and none of them have had it bad enough to go to hospital. So, you know.
Which is good, isn't it? And they've all been vaccinated. So the vaccine does work very well.
Yeah. Okay, on to equity markets. And I'm afraid the risk currents of the COVID, this new variant, is causing equity markets to take a bath. So all share down 2.7%, all of which is today, basically. Stocks Europe down 4.3, S&P. Now, the S&P numbers are all from last night, and they haven't yet suffered in the way that Asian and European markets have suffered. So S&P was only down 0.1% before today's open. NASDAQ down 0.9%. Topics, the Japanese index, down 2.9%. Bitcoin down 1%, 1.7%, sorry. Sterling down... Sorry?
I was going to say, Keith, Bitcoin is currently down 7%.
Oh, wow.
Today.
Okay. Right. So that was as of an hour ago. It was only down 1.7%. It's now down 7%. Sterling down 1.4%. The dollar index up 0.1%. And I've added that this week.
Yeah.
So some charts. Well, current valuations are for implying that over the coming decade, we will have annual returns of minus 1.3%. So markets look very stretched. Growth continues to underperform value, which is very surprising given the pickup in inflation. Analysts are expecting record corporate earnings, and that's shown you a lot of charts showing that earnings expectations remain elevated. Now, this is a chart from Simon W. of our Discord. This is a breakdown by Ernst & Young, of UK profit warnings, corporate profit warnings. And they're showing that 2021 has seen relatively low levels compared to history. If we break it down by sector, you'll see the biggest sector for profits warnings was actually fossil fuels, non-renewable energy. And that is all from the oil service sector due to the lack of capex, despite the very strong energy prices, oil prices. And if you look at the reasons for profit warnings, well, the number one came in as coronavirus. So coronavirus disruptions are still causing companies difficulties, although you do wonder how much of that is an excuse.
So we've just updated the charts for Ether and Bitcoin because they have taken a 9 and 7% fall this morning, respectively, in the charts were put in before that happened. So I have no comment really, other than to say clearly they're very susceptible to the news about this variant of the Delta variant, and people are clearly very worried about us returning to the situation we were in maybe 12 months ago. And if you look at the Bitcoin chart, we have the again, we have this is a daily chart, the Ether's a weekly chart, but we have a sharp fall today. What I would say is that, as you know, I've never been a huge fan of Bitcoin, but the thesis behind Ethereum is still in place. But obviously, it's a very volatile asset, and and it has proven its volatility today in spades. So, Keith, what's the next chart? Oh, the long-term trend. This is a logarithmic 12-month moving average is the dotted line versus the monthly candles, and you can see the long-term trend in Bitcoin. And clearly, it's currently at 54,000, so it's well within that closing triangle, the apex of the triangle. If you need comforting.
I saw a survey this week, Richard, that showed that 45% of young people who owned Bitcoin expected to become millionaires. So there you go.
Through their ownership of Bitcoin.
Yep.
Excellent.
Yeah. Well, if the Fed keeps on printing money, we can all be millionaires.
I think that's the case, isn't it? What's the guy's name? Charles Ponzi. That's right.
Yes. Now, this is the dollar index, and it's surprising that after the US has run an absolutely enormous fiscal deficit to fund all its stimulus campaigns and cut interest rates to essentially zero and done enormous QE, well, the dollar index has risen quite strongly this year.
So the dollar
up
index,
7%.
Yeah, and the dollar index is around about 50% made up of the euro, and of course the euro is as we've discussed earlier, the QE, low interest rates, negative interest rates, etc. It's not surprising it's fallen against the dollar. It's much worse than the Fed.
Yeah, that's true. But this is a sign that actually the dollar remains in demand. Okay, so on to energy markets. And we have yet another special segment for you. So this week, Biden announced a special release from the Strategic Petroleum Reserve of 50 million barrels of sour crude, which was coordinated with the UK, which released about 1.5 million barrels, but also India and China were meant to join in. Now, we have previously had a coordinated release of oil reserves back in 2011. So what are the lessons from then? Now, the background to the 2011 release were unrest in Libya, which took off a lot of supply, and then the big earthquake in Japan, which caused Japan to close down all its nuclear power stations and hence had a big increase in demand for natural gas in particular, but other fossil fuels. So you had reduced supply, increased demand, and a spike in oil prices. And so there was this coordinated release of oil reserves to try and dampen the market. Now, what happened? Well, the red rhomboid 6 shows the effect of the coordinated release of 60 million barrels. And you'll see that it had a big effect on the day, which really didn't last very long. It lasted only a couple of weeks. So on the day, oil fell by $7 a barrel, which is huge. 2.5 standard deviations, but it was back up above where it had been within 2 weeks. And if we look at what happened this time, this is what happened last time, huge drop and then quite rapid recoveries. So that's actually within 2 months. Okay, energy commodities. So crude. Sorry, Rich. Pause. Did I go through energy commodities? Well, crude is having a bad week. I mean, today essentially it's sold off and is down 3.6%. But, the background is that the oil market remains tight and the level of global stocks continues to fall. So the background remains bullish. We are just not investing enough. Replacement capex is running at 40% of what is required. And this is the capital expenditure of the oil majors, which just keeps on falling. As a result, the super majors, their production is down 10% from Q1 2020, and that's taken 1 million barrels a day out of the market with no sign that that will recover. And car use in Europe back to normal. Jet fuel demand, i.e. before today, was steadily recovering. And this is an aside, but I thought it was quite interesting. So this was actually from the Visual Capitalist, and it was showing the relative depths of various lakes and oceans. So you see Loch Ness is up here. It's only about 400 meters deep. And then you get down to the Atlantic, which is about 3,500 meters deep. The deepest you can go is the Marianas Trench in the Pacific, which is almost 11,000 meters deep. And bear in mind that Mount Everest is only 8,000 meters high. But then over here, you have the Deepwater Horizon BP rig, which famously blew up. And the oil well from the Deepwater Horizon goes down well over 11,000 meters to where the oil is. It just gives you an idea of how deep you have to drill, deeper than the deepest ocean. Amazing technological achievement, actually. Now, Dutch natural gas futures, well, I'm afraid it is just not improving. We are now starting to get the first cold of the coming winter. And I've read various commentary about we could actually have quite a bad winter because of La Nina, amongst other things. And will we run out of gas? Coal, in the meantime, has stabilized after its falls. Uranium is at recent highs. Moving on to industrial commodities. Richard, do you want to do these?
Yeah. So I'm just going to pick out the big changes. So cobalt was up 2.6 on the week. Iron ore up 18% on the week, which is a huge rise, but it's still down 36% on the year. And we know how volatile that's been. Magnesium down nearly 5%, but up 127% on the year. Nickel up 5.6% and 26% on the year. That possibly coincided with the iron ore increase and use of nickel in steel production. Tin is continuing its steady rise upwards, a small increase this week, and ferrovanadium up 2.2%, again, probably coincident with the price rise in iron ore. And see aluminium is all stabilizing at around about the 2600 level. And this chart shows that the Trafigura's forecast of aluminium supply deficit, which begins in 2023, which is actually pretty big, 6 million ton supply deficit by 2026 annually, and that's not good. And then this is the price of aluminium as we move towards a deficit situation, and aluminium stocks are drawing down quite quickly. We know car manufacture is not back up to anything like its pre-COVID levels. And so the position of aluminium looks like it's moving into a long-term deficit. Cobalt is just generally rising. Presumably that's as its demand as a battery metal. And this is a chart that Keith found where clean energy metals are produced. So basically, we are clean. We use clean energies. We don't pollute the environment. Aren't we great? But it comes from the Democratic Republic of Congo for cobalt, and they have no environmental controls. They use child labor. Where is it processed? Well, it's processed in China, and we've all seen the pictures of Chinese lakes that have been turned into huge chemical cesspools where nothing could possibly live. And so we're not really green at all. We just pretend we are. Copper is, well, it's been steady now, volatile but steady in its range for the last 6 months. And we do have a tight copper market, as we know. And this is interesting because if the premium has surged, then one would expect the actual prices to rise, to start rising again. So I don't think I think copper will continue to rise. I think it's just consolidating at the moment. Chromium in line with steel production, with iron production, I think, the iron price. Iron ore, well, it's 18%, but it's come down an awful long way. And lithium, it stays flat on the week by the look of it, Keith. So
yeah.
Pausing for breath. Magnesium. Neodymium was also stabilized. Looks like the battery metals are stabilizing a little bit. And nickel is continuing its rate. It's continuing its trend upwards, moving quite nicely within two parallel lines. Tin just going up for reasons we haven't yet discovered.
Yeah, and this is a chart going back to 1970.
Yeah,
puts things in perspective.
Yeah.
You would say, though, that when it's done this before, it's come back down pretty fast. So, wouldn't be speculating on it now.
Yeah, speculative interest, exactly. Ferrovanadium, stable, really nice, having a little 2% uptick, but it hasn't really gone anywhere for a couple of months. And on to precious metals, where gold had a poor week, as did silver, as did platinum, as did rhodium, and palladium had a particularly bad week.
Yeah, and they're all down on the year.
Yeah. Keith?
Well, this is just briefly, I thought this was quite interesting. This is where all the above ground gold is. And you'll see actually 46% of it is in jewelry. So much higher than I expected, actually. Then private investment is 22%, official holdings 17%, and 15% essentially unknown. If you look at the total stock, so we've got 200,000 tons has been mined, and then we have underground reserves of about 53,000 tons. So, small amounts. But gold has been an incredibly disappointing investment this year when we've had this spike in inflation of US 6.2% CPI, and gold is down on the year.
Well, look, I think there's no doubt that the central banks manipulate the price of gold because they don't want the dollar to appear bad or currencies to appear bad against gold, and they do that by writing vast quantities of gold contracts, and that's what's happening. There's no doubt about it. And the only thing that will change it will be if demand for physical gold produces a shortage of physical gold, and then the writing contracts for paper gold will no longer be able to influence the price. But until that happens, they can push the price around as much as they like with the paper gold, and that's what they're doing. So the silver is still in its range, as is gold, effectively. Yeah, well.
Yeah, the platinum, rhodium, palladium, all have been terrible this year, frankly.
Yeah.
Okay, on to rates. Well, this is as of this morning, and as of last night, rates had risen on the week as Biden had nominated Powell, and markets were expecting more interest rate rises next year. But then suddenly we've had COVID, and it's all reversed very quickly. So there's been safe haven buying of bonds across the curve in the UK. Now, what's interesting is in the periphery in Europe, in Greece, there hasn't been any safe haven bond buying, and yields rose on the week, and the same is true for Italy. So if we have a look at the chart, you see the Greek 10-year is now rising back up to new highs, and Italy is following it.
I just think you need to be careful on your definition of safe haven bond buying, because I believe the ECB thinks that the Greek bonds are actually safe haven.
Good point, Richard. Yes. So this is the UK 10-year, big drop today, and US as well. And I'm afraid the seasonality chart has been a poor guide this week because we've been totally flummoxed by COVID. Richard, what have you been up to this week?
Thank you, Keith. So I have had a slightly busier week than normal. So my weekly change is down about 1.2%. This is an approximation given what's been going on in the markets this morning. I've been buying uranium basically, and so I bought some yellow cake, which, as I'm sure you all know, basically buys uranium metal, and I've also bought some shares in Azaga Uranium Corp, and that is a TSX company, and it's an American US-based uranium miner. It has mines in the US. It has a very good investor presentation on its website for those who are interested, which tells you exactly what it does. One of the advantages of a US producer is that the US government is stipulating that a certain amount of uranium has to be bought by nuclear power stations in the US, has to be bought from US producers. In other words, to onshore uranium production and to reduce vulnerability to overseas uranium and dependence upon overseas uranium production, which puts the US-based US producers in an advantageous position regarding price and demand, and moves them a little bit away from the basic market. In addition, Sprott is expanding its Sprott Uranium Fund Trust to around about, I think, 3.5 billion, which will take another estimated 30 million pounds of uranium off the spot market. So, and add that to all of the projected, the supply deficit, the existing 50 million pound a year supply deficit, and the fact that uranium is the only way out of our fossil fuel crunch. I think uranium is a surefire bet, which means it's a surefire bet that I'm wrong. So I'm not buying any more. I'm done now. So this is Azaga Uranium. This is a long-term chart. So it was $45 in 2007, and it is now 62 cents. And this is so. For the point of information, I'm not suggesting it's going to go back up to $42. I don't know why it came off for $42. I have no idea, but I always find that kind of chart intriguing. And obviously it had a big rise in September when they all did, and it's been pretty steady since then. And this is yellow cake, which is, again, had that big rise in September. How about you, Keith? What were you up to this last week?
Well, as of this morning, I was doing quite well up until last night. And then this is as of 8:30 this morning.
Oh dear.
I'm having a total shocker. BP down 7.5% at that time. I think it's recovered a little bit last time I looked. But anyway, as of 8:30, I was having a very bad week, down 5.7% as oil companies take a huge bath. Remember, last time there was COVID disruption, the oil price bottomed at minus $40 a barrel. So the market does have some legitimate concerns.
We're not there yet, Keith. We're not there yet.
No, exactly. But anyway, I'm feeling actually remarkably relaxed about the whole thing, frankly. I think that we learn and adapt, and I don't think that COVID disruption will be anywhere near as bad as last time. So that takes me down to 4.7% on the year, which is all right. Frankly, anything above 7, I'm very happy with. If you can make 7% per annum, you double your wealth in 10 years. So, so I'm underperforming the oil share, but didn't have any sells or any buys this week. Now, a couple of charts that are of interest. we did a share talk on Hochschild Mining, which is a silver and gold producer with operations in Peru. Well, it didn't have a good week. The new socialist government in Peru came out with a statement that they were going to refuse the permit extensions for 4 mines in Peru that had been subject to protest by the indigenous population, 2 of which were owned by Hochschild. And we saw an absolutely enormous sell-off on the day from above £1.65 to 70p. So, best part of a 70% fall. And then it recovered strongly on the day. And then the socialist government basically backtracked on a lot of what they'd said, but there's a lot of uncertainty about what they're actually going to do. And then you've had the sell-off this morning. So a lot of political risk in Chile and Peru, and this is a very good illustration of jurisdiction risk.
Yeah.
Be careful. Okay, so Serica Energy, we did a share talk on and talked about how they had a gas field coming online in Q4. Well, they have announced that first gas, basically, and shares only rose 3.5% on the day, and then have taken a bad day today, down 6.7%. But gas prices are very elevated. Serica should be a big beneficiary. Now, we talked previously about Parkmead, and I was saying how it was the least active oil and gas company listed on the London. And I sold all of it from one of my accounts. Sadly, I've put in a limit order to sell the rest at 50p, hoping it'd recover. Came out results today, and the market didn't take them well, and it's collapsed. So, just goes to show that when you make a decision, you should just do it. So, anyway, so on that note, thank you all very much for watching through to the end. And please, can you press like and subscribe to the channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.